The 1929 crash is remembered as a sudden thunderclap, the day the stock market fell from the sky and the Great Depression began. But history is rarely that simple. The collapse of Wall Street in October 1929 wasn't just a bad day at the office or the punishment of greedy speculators. It was the end of a decade-long experiment in unrestrained optimism, a financial bubble inflated by debt, leverage, and blind faith in endless growth. When it burst, the world discovered that confidence is a fragile currency, and once it evaporates, no central bank or politician can conjure it back into existence overnight. Let's strip away the panic and the myths. The crash wasn't a single day of chaos. It was a process, years of excess building toward a predictable breaking point. And if you think this is just an old story of ticker tape and top hats, think again. The same ingredients are mixed into our financial system today: cheap money, speculative manias, inflated asset prices, and an entire culture that tells you markets always go up. The real lesson of 1929 is not how fast you can lose everything. It's how easily we convince ourselves that the party will never end. The stage was set in the Roaring Twenties, a decade of prosperity, consumerism, and technological wonder. America had emerged from the First World War as the richest nation on earth. Industry boomed. Automobiles, radios, and refrigerators transformed daily life. Cities grew, wages rose, and millions of Americans bought into a vision of endless abundance. But behind the glamour, cracks were already forming. Farmers were drowning in debt as crop prices collapsed. Wealth was concentrated in the hands of a few industrialists, leaving most households with little cushion if hard times came. And banks, lightly regulated and often reckless, were lending freely to anyone who wanted a slice of the action. The stock market became the great playground of the 20s. Between 1921 and 1929, the Dow Jones Industrial Average soared from 63 points to 381, a six-fold increase in just 8 years. Ordinary people, not just Wall Street insiders, piled into stocks. For the first time, millions of middle-class Americans became investors, convinced they were riding the wave of a new economic era. Brokerage houses opened offices across the country. Financial newspapers and radio shows fed the frenzy, promising riches to anyone bold enough to borrow and buy. And borrow they did. Margin trading, borrowing money to buy stocks, became the defining feature of the bubble. Investors could put down just 10% cash and borrow the rest. In other words, with $1,000, you could control $10,000 worth of stock. As long as the market rose, leverage multiplied the gains. But the moment prices dipped, brokers issued margin calls, forcing investors to either put up more cash or sell their shares at once. This system created a time bomb. The higher the market climbed, the more fragile it became. One slip, and the whole pyramid would collapse under the weight of forced selling. Even economists and leaders fed the illusion. In early 1929, Charles E. Mitchell, head of National City Bank, declared there was nothing to worry about. President Herbert Hoover promised a chicken in every pot, a car in every garage. The great economist Irving Fisher famously announced in October 1929 that stock prices had reached a permanently high plateau. These weren't fools. They were some of the smartest men of their age. But intelligence is no defense against collective euphoria. When the system rewards optimism and punishes caution, even experts become cheerleaders for a bubble. The warning signs were there. By 1928, the Federal Reserve began raising interest rates to cool speculation, but it was too little, too late. Credit had already flooded the system. In September 1929, the market peaked and cracks began to show. A few large investors quietly sold their positions, sensing the storm. Rumors spread. Then, in late October, the dam broke. On October 24th, known as Black Thursday, panic selling hit the market with 12.9 million shares traded, a record at the time. Banks and major firms tried to stem the tide, pooling money to buy stocks and restore confidence. It worked for a day. But by the following Tuesday, October 29th, the panic returned with a vengeance. More than 16 million shares changed hands. The ticker tape machines ran hours behind. Investors were wiped out in a single afternoon. The myth of endless prosperity was dead. But here's the truth. The crash itself didn't cause the Great Depression. It was the spark, not the fire. The deeper disaster came from the fragility of the financial system and the policy mistakes that followed. Banks had lent recklessly, often without adequate reserves. When loans defaulted, they collapsed. Between 1930 and 1933, more than 9,000 banks failed in the United States. Millions of people lost their life savings overnight. With credit frozen, businesses couldn't borrow, production collapsed, and unemployment soared to 25%. Global trade shrank as nations turned inward, erecting tariffs and protectionist walls. What began as a financial crisis metastasized into a worldwide depression. And yet, the crash was not inevitable. It was the result of decisions: weak regulation, unchecked speculation, blind faith in growth, and a failure to act decisively when trouble hit. That's what makes 1929 so haunting. It wasn't a natural disaster. It was man-made and preventable. The Great Depression revealed just how fragile the illusion of prosperity had been. Between 1929 and 1932, the stock market lost nearly 90% of its value. The Dow fell from that peak of 381 points to just 41. Imagine an entire generation watching the value of their savings, pensions, and investments evaporate day after day. Families who had borrowed heavily to ride the boom now found themselves drowning in debt, their collateral gone. Even those who had played cautiously weren't spared, because when banks failed, depositors lost everything. There was no federal insurance system, no safety net. If your bank collapsed, so did your financial freedom. Governments compounded the disaster with policies that made sense on paper but crushed the economy in practice. The United States passed the Smoot-Hawley tariff in 1930, designed to protect domestic industries by raising taxes on imports. Other countries retaliated, and global trade collapsed by 2/3 in just 4 years. At the same time, leaders clung to the gold standard, believing that confidence in currency required rigid adherence to gold reserves. But this trapped governments into tightening policy when they should have been stimulating demand. Countries that abandoned gold early, like Britain in 1931, began recovering sooner. The United States held on until 1933, prolonging the pain to be why the mid-30s. The Depression had reshaped societies. In Germany, economic despair fueled extremist movements, giving Adolf Hitler the opening he needed. In America, Franklin Roosevelt launched the New Deal, experimenting with public works, banking reforms, and social safety nets. The Securities and Exchange Commission was created to regulate markets, while the Federal Deposit Insurance Corporation insured bank deposits. These were not just bureaucratic changes. They were attempts to restore trust in a financial system that had utterly failed its citizens. The lesson was brutal but clear. Without confidence, without rules that protect ordinary savers and investors, the machinery of capitalism eats itself alive. Now, step back for a moment. Why does this still matter today? Because the mechanisms that created the 1929 crash are not dead. They are part of human nature, and they echo through every economic bubble since. Think of the dot-com mania in the late 1990s, when companies with no profits were valued at billions simply for having .com in their name. Think of the 2008 financial crisis, when subprime mortgages were bundled, repackaged, and sold around the world, inflating a housing bubble that nearly brought down the global system. The details change: tulips, railroads, tech stocks, crypto tokens, but the cycle is the same: easy credit, speculative frenzy, collapse, and then the desperate search for scapegoats. What's striking is how the very same phrases from 1929 reappear in every cycle. This time is different. We've reached a permanently high plateau. The fundamentals are strong. They are mantras of denial, chanted by politicians, bankers, and investors who cannot afford to admit that the foundation is rotting beneath their feet. The crash of 1929 reminds us that the most dangerous words in financial history are not about panic. They are about complacency. So what does this mean for us right now? Look at today's markets. Asset prices, from stocks to real estate, have been inflated by years of ultra-low interest rates and central bank interventions. Trillions of dollars of debt hang over governments, corporations, and households. Technology has created new speculative playgrounds, from meme stocks to cryptocurrencies. And just like in 1929, millions of ordinary people are convinced that the game is safe, that prices will always rise, that the system will protect them. But history tells a colder story. When confidence cracks, protection disappears, and those at the bottom of the pyramid are the first to be crushed. The real lesson of the 1929 crash is not about panic selling or ticker tape chaos. It is about resilience. The wealthy of that era, those who diversified, who held hard assets, who understood the cycle of boom and bust, survived and even grew stronger. The vulnerable, those who borrowed too much, who chased easy profits, who trusted banks without safeguards, were destroyed. That same dynamic plays out in every crisis. Which side of that equation you fall on depends on one thing: financial education. And this is where the story connects to you directly. Ask yourself, if the system wobbled tomorrow, if credit dried up, if markets fell by half, if your bank account was suddenly frozen, how prepared would you be? Would you be the margin trader of 1929, leveraged to the hilt, waiting for one margin call to wipe you out? Or would you be the investor who understood that wealth isn't paper promises but real, durable value? History doesn't repeat, but it rhymes with a cruel consistency. The names of the companies change, the instruments evolve, but the psychology is constant: greed, fear, denial, collapse. The 1929 crash, explained without panic, is not just a chapter of economic history. It's a mirror held up to our present moment. It forces us to ask, are we any wiser or just more sophisticated in our delusions? So the takeaway is brutally simple. Don't worship markets. Don't confuse speculation with wealth. Protect yourself with knowledge, with discipline, with the understanding that the system is not built to save you when things go wrong. Because they will go wrong. They always do. If this gave you a new perspective, hit subscribe. History has the answers, and I'll show you where to look.